How do residential, retail, and industrial REITs differ? Imagine building a portfolio that earns steady income and grows over time. You might have heard about real estate investment trusts or REITs. But did you know there are different types? Today, let's explore how residential, retail, and industrial REITs differ and what that means for your investment plans. REITs are companies that own, manage, or finance income-producing real estate. They let individual investors earn a share of the income without buying properties directly. Most focus on specific property types like apartments, shopping centers, or warehouses. This makes it easier for investors to diversify and target specific markets. Residential REITs invest in housing properties where people live. This includes apartment buildings, single-family rental homes, student housing, and senior living facilities. The main income comes from rent paid by tenants. These REITs tend to be more stable during economic downturns because people always need a place to live. For Asian American families who value stability and regular income, residential REITs can be a good choice. They often provide predictable cash flow, especially in cities with high rental demand. Investing in these REITs also aligns with cultural values of supporting family and community. Retail REITs own properties where businesses sell goods and services. Think shopping malls, strip centers, and outlet malls. They earn income by leasing space to retailers. The performance of retail REITs depends heavily on consumer spending habits. With more shopping moving online, some retail REITs face challenges. But those anchored by essential stores like grocery stores or pharmacies tend to stay stable. For Asian American investors, retail REITs might be appealing if they believe in the long-term strength of physical shopping areas, especially in neighborhoods with growing immigrant populations or unique shopping needs. However, retail REITs can be more sensitive to economic shifts and changes in shopping trends. Industrial REITs focus on properties used for manufacturing, storage, and distribution. This includes warehouses, logistics centers, and light industrial facilities. The rise of online shopping has increased demand for these spaces. Companies need warehouses to store and ship goods efficiently. Industrial REITs often have long-term leases with businesses, providing steady income. For investors interested in e-commerce growth and global trade, industrial REITs offer exposure to these trends. They tend to perform well in regions with busy ports or transportation hubs, making them attractive for long-term growth. Now let's compare these three. Residential REITs mainly earn from tenant rents and are generally less affected by economic swings. Retail REITs depend on retailer leases and can be more cyclical. Industrial REITs benefit from the growth of online shopping and logistics, often offering higher growth potential. In terms of risk, residential REITs are usually safer for income-focused investors. Retail REITs carry more risk if consumer habits shift. Industrial REITs face risks tied to economic changes and technological advances. For Asian American investors building wealth, diversifying across these types can balance risk and reward. Residential REITs provide reliable income, which is great for families seeking stability. Retail REITs might work if you know local shopping areas well or see growth in retail sectors. Industrial REITs could be a smart move if you want to tap into online shopping and global trade trends. When choosing, think about your goals, how much risk you're comfortable with, and your knowledge of local markets. Many communities have unique real estate needs, like high-density housing or retail centers catering to cultural preferences. Understanding these differences helps you pick the right REITs for your investment journey. Remember, each type offers different opportunities and risks, so choosing the right mix can help you grow your wealth steadily over time.